In Cambodia's rice belt, debt is more than a number. It's a rhythm of life, monthly, weekly, sometimes daily, sinking village time to the clocks of distant capital. This is a story about how informal loans didn't disappear with modernization. They evolved, and in doing so, made the system stronger. In early 2023, Cambodia's top banking leaders stood before cameras and blamed a crisis of over-indebtedness on one culprit: informal lenders, loan sharks, operating outside regulation. They promised a crackdown, but that wasn't the whole story, because the formal industry depends on the informal one, profitably. In the Cambodian countryside, banks and MFIs, microfinance institutions, lend to moneylenders, who then lend to farmers. Debtors juggle both sides to stay afloat, and the industry frames informality as the sole problem to protect its image and cash flows. Debt isn't just for farming. Households borrow for medical care, schooling, life ceremonies, and to smooth income when the climate turns against them. When harvests fail or jobs vanish, the debt clock doesn't stop. Scholarship about debt in agrarian studies provides two important lessons to enable our understanding how microfinance facilitates financialization in rural contexts. First, credit-debt relations are always shaped by the broader conjuncture of agrarian production and social reproduction. Classic agrarian Marxists tended to see peasant indebtedness as a retrogressive force in the development of capitalism, because usurious moneylenders rarely reinvested their appropriated surplus into improving the productivity of labor. However, the role of debt tends to change once the broader conditions of capitalist production are in place. These conditions include the privatization of property, the commodification of labor, and the dependence on markets for social reproduction. In such conditions, debt becomes a lever for disciplining labor, accelerating differentiation, and producing surplus populations, which are all crucial for the expanded accumulation of capital. Second, the outcomes of credit-debt relations are shaped by the position of debtors within the agrarian class structure. Agrarian capitalists can leverage credit to solidify their class position by investing in more land, means of production, or control over trade. In contrast, poorer agrarian households may find that debt adds to their vulnerability. Class positions also intersect with other relations of power, based on gender, caste, and race, which variously influence the terms and conditions of debt. How financialization manifests in the countryside is thus shaped by the complex intersectional power dynamics of credit-debt relations found in agrarian, political, economic, and social life. Agrarian financial landscapes persistently include informal credit-debt relations, despite decades of developmental efforts to replace informal lenders with state and private credit around the world. To explain this persistence of informal lenders, development economists developed the concept of financial dualism in the 1980s and 90s. This concept segmented rural financial markets into formal and informal financial sectors based on how they were regulated. The formal sector included institutions that were regulated, registered, or certified by state authorities, whereas the informal sector was comprised of an assortment of financial actors who operated outside of state oversight. In addition to this regulatory distinction, the concept of financial dualism further distinguished the two sectors by their institutional features, namely how lenders address problems of information asymmetry and moral hazard. Finally, the concept of financial dualism noted that formal and informal lenders were not always in competition, but served complementary roles in meeting the economic and social needs of rural households. For instance, Informal services were often better suited to funding short-term operational costs of production, such as inputs and wages, compared to long-term investments into machinery or land. However, the concept of financial dualism is insufficient for explaining the relation between financialization and informal debt in the countryside. This is because there exist diverse, complex, and multi-faced forms of interconnection, appropriation, accommodation, reconfiguration, and struggle between financial institutions. The question to ask is, how do these institutional interconnections affect processes of financialization in the countryside? To answer lies in three dimensions of the co-productive relationship between informal debt and financialization: practices of on-lending, juggling debt, and discourses of informality. Now, I provide you with context information about Battambang in Cambodia. Battambang is Cambodia's rice bowl, a province rebuilt after war, a rural economy integrated into global markets. But beneath this calm surface, another system is at work. A system of credit, debt, and obligation, quiet, contractual, and deeply woven into everyday rural life. Not the violent dispossession of the past, but something slower, something contractual. To understand how rice farming in Battambang works today, we need to understand how debt became part of survival itself. In 1979, Cambodia emerged from one of the most devastating social collapses of the 20th century. The Khmer Rouge had destroyed institutions, erased markets, and dismantled the financial system entirely. When a new socialist government took power, rebuilding agriculture became an urgent national priority. In the 1980s, the state attempted to reconstruct production, redistributing land, restoring irrigation, and providing limited credit through state channels. But by the late 1980s, that model began to change. Market reforms arrived, private property returned, controls loosened, and after the 1991 Paris peace agreements ended decades of civil war, Cambodia opened itself to the world, to foreign aid, development agencies, and international capital. In Battambang, development projects multiplied. Roads were rebuilt, canals dug, new seed varieties introduced. Mechanization encouraged. Agriculture was being modernized. And with modernization came a new need: money. Before formal banks returned to rural Cambodia, farmers still had to borrow. They borrowed from people they knew: local moneylenders, merchants selling seeds and fertilizer on credit, wealthier landowners, friends, relatives, neighbors. These loans were personal, trust-based, negotiated face-to-face, often tied to labor, land rental, or shared harvests. A farmer might repay in rice, or labor, or loyalty. Interest rates could be high, but terms were flexible. Repayment could be delayed. Circumstances negotiated. This informal financial system wasn't modern, but it was embedded in village life. And then, at the turn of the century, something new arrived: microfinance. Microfinance entered Cambodia with a promise: small loans, poverty reduction, entrepreneurship. Early microfinance organizations were NGOs, often operating in villages like those in Battambang. Loans were delivered to groups, without collateral, intended to fund farming, food processing, or handicrafts. But this changed quickly. In the 2000s, microfinance institutions began transforming into commercial lenders. They received licenses, took deposits, used land titles as collateral. Behind the scenes, global finance arrived: private equity funds, development finance institutions, foreign banks from across East and Southeast Asia. Cambodia's microfinance sector expanded faster than almost anywhere else in the world. And Battambang, fertile, productive, export-oriented, became one of its core markets. Today, Battambang's rice farmers are no longer producing just for local consumption. They are producing for regional and global markets. Large exporters work with the government to ship rice to Europe and China. Storage facilities, drying equipment, and export certification standards now shape how rice is grown. Farming has become more intensive, more mechanized, more expensive. Farmers near irrigation canals can harvest 2 or 3 crops per year, but each crop requires fertilizer, hired labor, fuel, machinery, and land rent. Between 2000 and 2019, the number of households borrowing for farming in Battambang tripled. Credit is no longer optional, it is part of production. Over the past 2 decades, farmers have changed who they borrow from. For inputs, seeds, chemicals, fertilizer, many still rely on agricultural merchants. These loans are quick, require no land collateral, and often charge lower monthly interest. But for larger expenses, machinery, land rental, rising seasonal costs, farmers increasingly turn to banks and microfinance institutions. By 2019, formal lenders had replaced moneylenders and family loans as the primary source of non-input agricultural credit. These loans are bigger, longer term, lower interest on paper, but they come with conditions, collateral, strict repayment schedules, no flexibility. For wealthier farmers, these loans enable expansion. For poorer farmers, they introduce risk. Farming is only part of the story. Most households cannot survive on agriculture alone. Healthcare is largely private. Education often requires extra fees. Weddings, funerals, and ceremonies have become increasingly expensive. When emergencies happen, illness, crop failure, school costs, families borrow again. Often informally. Despite the expansion of banks, nearly half of households still rely on informal lenders alongside formal loans. Why? Because moneylenders are faster, less bureaucratic, more flexible. As one farmer explained, banks demand repayment without delay. Even minutes late can bring penalties. Local lenders, by contrast, might wait. Even at higher interest, flexibility can be the difference between survival and collapse. When people talk about banking in Cambodia, they usually imagine offices, paperwork, and formal loans. When they talk about informal debt, they imagine something separate. Local moneylenders, small shop owners, loans made quietly face-to-face. 2 different worlds. But in rural Cambodia, those worlds are not apart. They are connected. In fact, informal debt doesn't stand outside Cambodia's financial system. It moves inside it, through it, and for it. To see how Cambodia's banking industry really works, we need to stop looking only at banks and start looking at the moneylenders who quietly extend their reach. In villages like Sala and Baku in Battambang province, nearly half of households still borrow informally from moneylenders, merchants, or family members, even as banks and microfinance institutions spread throughout the countryside. Why? Because households don't borrow for just one reason. They borrow for farming, for illness, for ceremonies, for emergencies that cannot wait for paperwork. Informal lenders specialize in complexity. Formal institutions specialize in rules. And this difference has quietly reshaped how finance capital moves through rural Cambodia. It's easy to imagine informal lenders as isolated village figures, operating with their own money, circulating cash locally. But that image is incomplete. In Sala and Baku villages, nearly every major informal lender had something in common. They had bank loans, large ones, amounts ranging from $10,000 to nearly $200,000 US. Those funds didn't stay in the bank. They were re-lent. One formal loan became 20 or 30 informal loans. This practice is officially illegal. Moneylenders are not licensed to provide financial services. But enforcement is almost non-existent. Why? Because on paper, these lenders are something else. They run grocery stores, rice mills, restaurants, trading businesses. The loan is registered for commerce. What happens to the money after that is invisible. Through on-lending, informal lenders act as intermediaries. They connect banks, often headquartered far from the village, to households banks cannot easily reach. This is especially visible in geography. Villages closer to highways borrow more directly from banks. More remote villages rely primarily on merchants and moneylenders. But even there, the money still traces back to formal finance. What looks like a local loan is often global money moving through layers. Foreign equity enters Cambodian banks. Banks lend to informal lenders. Informal lenders lend to farmers. Finance capital flows. Even where banks appear absent, informal lending does not block financialization. It completes it. This layering of credit comes at a cost. Banks charge interest. Moneylenders must charge more. If a bank lends at 10 to 18% per year, moneylenders must charge 24, 40, sometimes 60%, just to remain solvent. At the bottom of this hierarchy are what villagers call daily lenders, short-term loans, interest charged per day, used for food and survival. The deeper debt travels down this chain, the harsher its terms become. This is not accidental. It is how value is extracted at each layer. Debt doesn't just extract value, it disciplines behavior. During the COVID-19 pandemic, that discipline intensified. When farmers could not repay, informal lenders faced their own deadlines. Some owed over $100,000 to multiple banks. Credit officers came demanding payment. Under pressure, flexibility disappeared. Grace periods vanished. Threats increased. People fled villages, migrated abroad, disappeared. Debt enforcement cascaded downward. From global finance to banks, to informal lenders, to households. The system tightened everywhere at once. Not all moneylenders are equal. Some carry authority, connections, power. In some villages, prominent lenders are tied to local officials. Fear ensures repayment. Outside lenders, especially those arriving after COVID, carry even darker reputations. Stories circulate of intimidation, harassment, violence. Whether all are true matters less than their effect. People repay even when it costs land, food, or dignity. In Battambang, debt is not something people take on once. It is something they juggle, month to month, loan to loan, creditor to creditor. On paper, repayment rates in rural Cambodia look unusually high. Banks report discipline. Investors see stability. But behind those numbers is a fragile balancing act, one that depends on informal debt to keep formal debt alive. This is not a story about irresponsibility. It is a story about how farmers stay afloat in a system that demands punctual payments from lives that are anything but predictable. In villages like Baku and Sala, nearly 1/3 of indebted households reported juggling debt. That doesn't mean borrowing more for consumption. It means borrowing to repay a medical emergency, a flood, a failed crop. When cash is needed immediately, banks are too slow. Paperwork takes days, so households turn first to local moneylenders. These loans are fast but expensive. Short maturities, high interest. They solve the immediate crisis, but they create another one. When bankers describe Cambodia's debt problem, they tell a simple story. People hide loans. People deceive institutions. People stack debts irresponsibly. From their perspective, juggling debt looks like fraud. And this framing has driven a national effort to clamp down on informal lending. But this interpretation skips something essential. Most households are not juggling to escape banks. They are juggling to survive banks. In Baku and Sala villages, the average household owed more than $8,400 to a bank or microfinance institution. That is an enormous sum for a rice farming household. By comparison, average informal debt was under $700. The danger doesn't come from the small loans. It comes from the large ones. Formal loans are long-term, collateralized, strictly scheduled. Once a land title is deposited with a bank, flexibility disappears. In times of crisis, illness, crop failure, pandemics, households face a stark choice: miss one payment and risk losing land, or borrow elsewhere to stay current. To manage this risk, many households refinance one loan with another. A farmer borrows from a local moneylender to repay a bank. Once the bank loan is cleared, they apply again for formal credit. That loan is then used to repay the moneylender. It's an elaborate dance, but it has a logic. Moneylenders offer flexibility but charge high interest. Banks offer lower interest but demand discipline. Households move between them, trying to keep all debts manageable and preferably in one place. But this requires constant negotiation and permission. Formal credit officers are not neutral observers. They're under pressure themselves. In Cambodia's competitive banking sector, officers are rewarded not just for lending, but for perfect repayment records. Missed payments affect bonuses. Late accounts threaten careers. As a result, some officers quietly encourage borrowers to find money elsewhere, anywhere, to prevent delinquency. Informal debt becomes a tool of formal discipline. It is not outside the system, it supports it. For many households, juggling debt means borrowing every month just to stay current. Formal repayments often exceed monthly income, especially when income is seasonal. Farm earnings arrive after harvest. Loan payments arrive every month. The mismatch is structural, so borrowers turn to relatives, neighbors, moneylenders. Short-term loans bridge the gap between income and obligation. Being a good borrower means always showing up on time, even if the money isn't really yours. People repay not because they are thriving, but because they are afraid. Land titles are on deposit. Homes, fields, inheritance. Default feels catastrophic. Borrowers fear being cut off from future credit. They fear harassment. They fear losing land that took generations to accumulate. In this context, juggling debt is not reckless, it is defensive. For years, Cambodia's banking system was praised as a success. High repayment rates, rapid expansion. Millions of rural borrowers brought into the formal financial system. But in recent years, that image has begun to crack. Across the countryside, farmers, factory workers, and indebted families have started speaking out. Human rights groups have documented stories of land loss, children pulled out of school, meals skipped, and mass migration in search of cash. What was once framed as financial inclusion now looks increasingly like something else. And as pressure mounts, a question has moved to the center of Cambodia's debt debate. Who is really responsible? In 2022, two Cambodian human rights organizations, Liquido and Equitable Cambodia, took an unprecedented step. They filed a formal complaint against the International Finance Corporation, the private sector arm of the World Bank. The allegation was not abstract. They claimed that international finance had knowingly supported lending institutions that pushed rural households into harmful levels of debt, triggering land sales, hunger, family separation, and forced migration. For the first time in its history, the IFC opened an internal investigation into its own investments in Cambodia's microfinance sector. The illusion that Cambodia's debt problem was marginal or accidental had been publicly challenged. Banks and investors responded quickly. They denied wrongdoing, rejected responsibility, and redirected blame. At press conferences and public forums, industry leaders insisted that the real problem was not formal finance, but informal lending, predatory moneylenders, illegal operators, loan sharks. According to this narrative, informal debt was poisoning the system, dragging borrowers into over-indebtedness and threatening the stability of legitimate financial institutions. Authorities echoed this view. Warnings were issued, criminal charges promised, crackdowns announced. In this telling, the crisis had a clear villain. But this explanation glosses over a central contradiction. Informal lending did not emerge in opposition to the banking system. It exists alongside it, inside it, and often because of it. Moneylenders, merchants, neighbors, and kin have long provided households with fast, flexible access to cash, especially during illness, emergencies, or moments when banks are closed. Even leaders within the banking industry admit this. Without informal credit, some people would simply not reach the hospital in time. Criminalizing all informal lending, then, is neither realistic nor humane in a country where public health services are limited and social protection is thin. The distinction between formal and informal finance appears neat on paper. In practice, it collapses. While the National Bank licenses institutions in Phnom Penh, loan enforcement happens in villages. Local authorities, commune chiefs, village leaders, verify loan applications, mediate disputes, and pressure borrowers to repay. These same officials are often involved in informal lending themselves. Some accept bribes, some profit directly from debt. Some act as intermediaries for banks. The result is a regulatory gray zone where power flows downward, but accountability does not. When these same authorities are tasked with cracking down on informal lenders, conflicts of interest are not an exception. They are the rule. Rather than confront these structural entanglements, regulators have promoted a different solution: financial literacy. Across Cambodia, people are taught how to borrow responsibly. Workshops are held, radio programs broadcast, lessons added to school curricula. The stated goal is simple: discourage borrowing from moneylenders. But financial literacy does more than educate. It reshapes behavior. In practice, many financial literacy programs are delivered by credit officers themselves. During training sessions, banks advertise their own products. They compare themselves favorably to informal lenders. They emphasize one lesson above all others: a good borrower always repays on time. Saving matters less. Insurance is secondary. Debt repayment is framed as moral responsibility. Repaying a loan is not just an obligation, it becomes a virtue. And failing to repay becomes a personal failure, regardless of floods, illness, or lost income. Through this lens, over-indebtedness is no longer structural, it is individual. People are in debt because they are careless, uninformed, tempted by loan sharks. This framing dominates national policy. Official strategies describe debt distress as the result of poor consumer knowledge and informal operators, not intense competition among banks, or the pursuit of shareholder returns. By individualizing responsibility, the system absolves itself. At the same time, the Cambodian state narrowed its role in providing healthcare, education, and social protection. Households borrowed to farm, they also borrowed to survive. What was once occasional credit became permanent obligation. As household debt increased, so did Cambodia's banking industry. Since the 1990s, banks and microfinance institutions expanded rapidly, fueled by government reforms, foreign investment, and global development finance. These institutions integrated Cambodia into regional and international financial circuits. Capital flowed in, interest flowed out. But this formal expansion did not eliminate informal finance. It depended on it. One of the biggest mistakes in how we talk about rural debt is treating it as a single relationship. One borrower, one lender. In reality, farmers navigate multiple debts at once. Bank loans, merchant credit, money lenders, family and neighbors. These debts overlap. Informal lenders borrow from banks. Households borrow from both. Loans are swapped, refinanced, balanced month by month. Debt here is a network, and informal finance is one of the main channels through which formal capital reaches the countryside. Debt is not inherently destructive. It can enable investment, bridge gaps, create opportunity. In Battambang, loans allowed farmers to mechanize, purchase inputs, and remain competitive. But debt becomes dangerous when it replaces public support. When healthcare is private, when education costs money, when climate shocks hit. In these conditions, debt shifts from tool to trap, and whether debt helps or harms depends less on access and more on terms. For many households, the ability to reproduce daily life now depends on borrowing. Loans are used to plant rice, to pay hospital bills, to send children to school. Households are incorporated into global commodity markets, but without the protections needed to survive them. Credit fills the gap left by the state, but at a cost. Interest accumulates, collateral tightens, risk shifts downward. Despite mounting evidence of harm, the dominant narrative remains unchanged. Financial inclusion is still framed as development. Formal credit is still positioned as salvation. Informal debt is still blamed for everything that goes wrong. But informal lenders did not undermine the banking sector. They sustained it. Banks expanded because informal systems absorbed risk, enforced discipline, and extended reach. And yet this relationship remains unacknowledged. Instead of confronting this interdependence, responses have followed a familiar pattern. Criminalize informal lenders, promote financial literacy, blame individual borrowers. Responsibility is displaced. Banks and investors remain legitimate. Debtors are framed as ignorant. Structural causes disappear from view. This has real consequences, especially as international investigators now examine the role of development finance in Cambodia's debt crisis. To support us in bringing you more of the political economy of agrarian production, please subscribe to this channel. We will be back again with another story from the field every Wednesday on this channel.